The cash flow statement is a financial statement that provides information about the inflows and outflows of cash within an organization over a specific period of time. It is an essential component of financial reporting because it helps stakeholders understand how cash is being generated and used by the business. The cash flow statement is divided into three main sections: operating activities, investing activities, and financing activities. Let's take a closer look at each section. Operating activities. This section focuses on the cash flows that are directly related to the core operations of the business. It includes cash receipts and payments resulting from the day-to-day activities, such as sales and purchases of goods or services. Operating activities primarily involve the following: cash inflows from customers, cash outflows to suppliers, cash outflows to employees, cash outflows for operating expenses. Investing activities. This section covers cash flows related to the acquisition and disposal of long-term assets, such as property, plant, and equipment. Investing activities typically include cash outflows for the purchase of fixed assets, cash inflows from the sale of fixed assets, cash outflows for investments in other companies, cash inflows from the sale of investments or subsidiaries. Financing activities. This section focuses on cash flows related to the financing of the business. It involves activities that affect the company's capital structure, such as obtaining funds from investors or repaying loans. Financing activities generally include cash inflows from issuing equity, think of shares of a company, cash inflows from borrowing, cash outflows for dividends paid to shareholders, cash outflows for repayment of borrowings. At the bottom of the cash flow statement, the net change in cash is calculated by summing up the cash flows from all three sections. This net change in cash is added to the beginning cash balance to derive the ending cash balance for the period. The cash flow statement is important because it provides insights into the liquidity and solvency of a business. It helps users assess the ability of an organization to generate cash, meet its financial obligations, and fund future investments. By analyzing the cash flow statement, stakeholders can evaluate the overall financial health and cash management practices of a company. Learn about the balance sheet next. Just click here.